While much of the world was celebrating silver's historic breakout on Monday, something far more sinister was unfolding behind the scenes of the financial system. This wasn't normal trading activity, it was an act of sabotage. Late into the night, hidden from public view, exchange officials and executives from the largest bullion banks convened an emergency meeting. They understood one brutal truth. A truly free market was about to wipe them out. Silver had shattered the $75 level, and internal projections pointed directly toward $100. Only two paths remained: accept massive losses and face collapse, or rewrite the rules to extract wealth from investors. They chose manipulation. At 3 a.m., a quiet notice appeared on the exchange's website. No press release, no headlines, no social media alerts, yet the impact was immediate. Margin requirements were raised to extreme levels. This was not a routine regulatory move. It was a calculated weapon designed to force retail traders out of profitable positions. They failed to defeat you through honest price discovery, so they pressured the referee to alter the outcome. To grasp how deep this betrayal runs, you must understand margin mechanics. Futures trading relies on leverage. A trader deposits a relatively small amount of capital to control a much larger position in silver. The system only functions smoothly while banks are winning. Once they begin losing, the rules suddenly change. The adjustment implemented overnight nearly doubled the cash required to maintain open positions. Imagine purchasing a home, finalizing the deal, then receiving a call the next day demanding tens of thousands more in cash by noon, or losing the property entirely. That scenario is now reality for thousands of traders. Margin calls are being issued not because prices fell, but because the exchange rewrote the rules mid-game. Forced liquidations are being engineered to create artificial selling pressure, all to protect a collapsing banking balance sheet. Yet even this wasn't enough to halt the surge in demand. Reports are emerging across multiple brokerage platforms that buy orders are being blocked or heavily restricted. The pattern is familiar. Traders attempting to open new silver positions encounter messages like risk limits reached or trading restricted to liquidation only. In plain terms, investors are permitted to sell silver back to the banks but are prohibited from buying more. When buying is removed and selling remains, price movement becomes one-sided. This is not a free market. It is a controlled implosion, designed to suppress demand and allow short positions to be quietly unwound at discounted prices. This is market manipulation in its most blatant and unlawful form. While access for investors is being deliberately restricted, the banks are simultaneously deploying their own trading algorithms to manufacture a false narrative. Earlier today, enormous sale walls suddenly appeared across the order book. Single blocks representing millions of ounces were placed just below the market, instantly spooking traders. But there is a critical detail most people miss. These sell orders were never real. This tactic is known as spoofing. The banks submit massive sell orders with no intention of executing them. Just moments before they would be filled, the orders are pulled. The goal is not to sell metal, but to create the illusion of overwhelming supply. The price chart is being deliberately manipulated. They want you to believe the market is collapsing, when in reality, demand remains overwhelming. This is a coordinated psychological operation designed to flush out nervous holders and transfer metal back to the banks. And this brings us to the central role of the exchange itself. The exchange is meant to act as an impartial referee, enforcing fair and transparent rules. Instead, it has become an extension of the institutions it claims to regulate. The exchange is controlled by the same banks dominating the paper silver market. Many board members are former executives from major financial institutions. When rule changes are announced, they are not made to protect market integrity. They are made to shield insiders by hiking margin requirements and limiting positions. The exchange has abandoned its obligation to the public. This episode confirms what many already suspected. The paper market is not a mechanism for true price discovery. It is a casino where success is tolerated only until it threatens the house. The credibility of the exchange collapsed today. Its reputation was willingly sacrificed to preserve the balance sheets of a failing cartel. History offers a clear parallel. In 1980, the Hunt brothers accumulated a dominant position in silver, driving prices sharply higher. The banking system was pushed to the brink. In response, the exchange rewrote the rules, introducing a sell-only restriction. The price collapsed from $50 to $10 in a short period of time. But this time, the situation is fundamentally different. Yes, back then, demand was largely speculative. Today, silver is a critical industrial input. You cannot impose liquidation-only rules on global manufacturers. Technology and energy producers require physical metal to operate. Rule changes may scare traders, but they cannot eliminate real-world consumption. The banks are attempting to defy physical reality. and reality always prevails. Perhaps the most compelling proof of manipulation is the widening gap between paper prices and physical prices, while the digital quote is being pushed lower. The physical market tells a completely different story. Anyone attempting to acquire large physical bars today is being quoted premiums far above the so-called spot price. This divergence exposes the paper price for what it truly is, a distorted signal disconnected from real supply and demand. Why does this gap exist? Because the quoted spot price is fiction. The paper price is a coordinated lie maintained by insiders. The only price that matters is the amount required to obtain physical metal in your possession. This growing disconnect exposes how irrelevant the exchange has become. Banks can crush paper prices to nothing if they choose, but they cannot conjure silver into your vault. The market has split in two. There is the price dictated by banks, and there is the price paid by the public. Investors must now understand the next phase of this escalation. Hidden deep within the exchange's user agreement is a provision known as force majeure. This clause grants the exchange the power to cancel contracts during so-called emergencies, if silver continues rising, despite ongoing manipulation. This clause will likely be invoked. The justification will be simple. They will claim physical delivery is impossible due to shortages and offer a cash settlement based on a previously manipulated price. This is legalized expropriation. It converts real ownership into a paper promise. The legal groundwork is already being laid for a coordinated default. They know the vaults are depleted, and they are rewriting the rules to shield themselves from responsibility when the rush for metal begins. So where is the public outrage? Where are the official investigations? Turn on mainstream financial media, and you are met with silence. Major financial outlets are ignoring the most consequential story in modern markets. Margin hikes go unmentioned. Physical shortages are dismissed instead. Silver is labelled a speculative fad or an irrational bubble. The synchronized media blackout is driven by advertising revenue. Banks are among the largest sponsors of these networks by controlling the narrative. They keep the public uninformed. They want price declines to appear organic rather than engineered. Suppressing the truth has become just as important as suppressing the price itself. Why would institutions go this far? Why risk exposure, prosecution, or systemic unrest? Because one major institution is cornered. It carries an unprecedented short position in the silver market. If prices reach triple digits, the losses would overwhelm its core capital reserves. Put simply, failure becomes unavoidable. This reality explains the regulatory response. Authorities understand that if this institution collapses, the shock could destabilize the entire banking system. It has been labelled too large to fail, and in return, it has been granted permission to distort markets to survive. This is no longer a battle against a single bank. It is a confrontation with the combined force of political power and financial elites. Yet there is one major player operating outside this system. China. The Shanghai Gold Exchange functions beyond the reach of Western exchanges. From Beijing's perspective, this manipulation signals weakness. Each time prices are artificially pushed down, China increases its accumulation. The artificially suppressed price is being used to extract the remaining strategic metal reserves from the West. The Chinese government is actively encouraging its population to accumulate gold and silver, while the West continues to trade paper promises. China is stockpiling real metal through manipulation and short-term greed. American banks are unintentionally transferring long-term economic power to the East. They are trading generational strength for immediate survival. These rule changes are also enraging major industrial players. Corporations such as Samsung, Tesla, and Sony depend on futures markets to manage costs and secure supply. When exchanges distort pricing mechanisms, it becomes impossible for these companies to plan or hedge effectively. Reports are emerging that large industrial buyers are abandoning the exchange entirely and negotiating direct supply agreements with mining companies. This marks the beginning of the end for the exchange. Without industrial participation, it devolves into nothing more than a paper casino for speculators. The real physical market is drifting away from New York, leaving banks to trade imaginary contracts with one another. The banks made a fatal error. They believed that collapsing prices and rewriting rules would frighten retail investors into retreat. Instead, they achieved the opposite. Panic never came. Anger did. Online forums and social platforms are erupting with outrage. Investors are not exiting positions. They are increasing them. Capital is being withdrawn from the financial system and redirected into physical metal as a form of protest and punishment. This has evolved beyond a simple investment strategy. It has become a collective response. What we are witnessing now is a financial uprising. Each act of manipulation reinforces the underlying thesis. A new generation of investors is being forged. One that will never place blind trust in fiat currencies again. Banks want to project an image of total control. They want you to believe they dictate price and outcome. Yet their recent behavior tells a different story. Frantic rule changes, sudden margin hikes, and blatant spoofing are not signs of strength. They are the actions of a cornered animal fighting for survival. True power does not require cheating. Open manipulation signals loss of control over fundamental forces. They are attempting to hold back a tidal wave with inadequate tools. Delay is possible, prevention is not. Cracks are spreading, and the system is running out of ways to contain them. What we are seeing is the collapse of the free market ideal. When rules are rewritten every time powerful players lose money, the market ceases to exist. What remains is a rigged mechanism that encourages reckless behavior. Knowing losses will be socialized. This erosion of accountability destroys trust, and trust is the only foundation supporting the United States dollar. By manipulating the silver market, institutions are undermining confidence in the broader economy. They are sacrificing long-term stability to preserve short-term power. Meanwhile, despite all paper maneuvers, the physical supply crisis continues to intensify. Mines are being depleted, and replacement supply is not keeping pace. Ore grades are declining. No significant new silver deposits have been discovered in over a decade. Consumption is now outpacing production, and above-ground inventories have already been depleted. What remains are strategic reserves, and those are being drawn down rapidly. Banks can issue endless paper contracts, but they cannot manufacture geology. The structural supply deficit is undeniable. Sooner or later, real industrial demand will overpower paper manipulation. When manufacturers are forced to halt production due to a lack of silver, prices will explode upward, regardless of what exchange rules attempt to dictate. A large portion of short selling is buried in the shadow banking system, specifically the over-the-counter market. These positions are invisible to the public. This is where the true leverage resides. Estimates suggest the real short exposure may be 5 to 10 times larger than reported figures. This hidden liability is a ticking bomb as interest rates climb and silver prices rise. Maintaining these opaque positions becomes increasingly unsustainable. The bullion banks are approaching a classic Minsky moment, a sudden and violent collapse driven by excessive hidden leverage. Despite all manipulation, wealth transfer is still underway. Every ounce of physical silver acquired removes collateral from the system. That metal can no longer be used to cover short positions. This is why investors are being pressured to sell. The banks need that silver back. Do not surrender it. Volatility is simply the cost of participation. Manipulation itself is proof of progress. We are deep into the final rounds of a heavyweight bout. The opponent is fighting dirty, striking below the belt. But fatigue is setting in. One more sustained push. One more wave of physical demand, and the structure gives way. The conclusion is unavoidable. It ends with the collapse of the exchange-based pricing system. Physical silver will fully detach from paper valuations. A parallel market will emerge where real metal trades at multiples of the official. Quote, eventually, the paper price will be forced to chase reality, and the convergence will be abrupt and violent. Banks will be rescued through monetary expansion. Currencies will be diluted to fund the bailout. Those holding physical metal will be the last ones standing with preserved purchasing power. Manipulation does not signal the end of the squeeze. It signals its final stage. Rules are changed because losses are mounting. Trading is halted because fear has taken hold. They want capitulation, they want exhaustion. But the facts are clear. Vaults are empty. The numbers do not lie. The system is fractured, and silver exposes that fracture. Do not allow your future to be erased by rewritten rules. Hold your position. Demand delivery. Drain the vaults. The age of manipulation is fading, and the era of the people is beginning.